Imagine sitting across from one of the greatest investors of our time, someone whose moves have consistently outpaced the market, and whose instincts have made billion-dollar bets look effortless. Stanley Druckenmiller doesn't speak in vague advice or half measures. He cuts straight to the point, warning about risks that most people ignore until it's too late now. As April 2026 approaches, he's signaling a move that could reshape how everyday people think about their savings, urging a withdrawal strategy that could shield you from unexpected financial turbulence. This isn't speculation. It's the kind of insight only someone of Druckenmiller's experience can deliver. Protecting cash from potential market volatility before April 26 is not just a cautious move. It's a mindset that separates those who survive financial turbulence from those who get blindsided by it. Stanley Druckenmiller, known for navigating some of the most treacherous market environments in modern history, has long emphasized the importance of staying ahead of risk rather than reacting to it. When he talks about protecting cash, he isn't merely suggesting a temporary withdrawal or a casual hedge. He's pointing to a deeper principle that applies to every layer of one's financial life: anticipate the storm, act decisively, and maintain flexibility to maneuver when circumstances shift unexpectedly. The thrill of this approach comes not from reckless speculation, but from a calculated recognition that the financial world is rarely as stable as it appears. Markets have a rhythm, a pulse, and history shows us that volatility often arrives in waves that can wipe out years of accumulated wealth if unprepared. Imagine looking at your bank balance, knowing that every dollar sitting idly could be eroded by forces beyond your control: interest rate shifts, policy changes, or sudden market contractions. For many, the comfort of a bank account feels like safety, a concrete number that can be counted and trusted. But Druckenmiller challenges that sense of security. He teaches that real safety lies in understanding the invisible currents beneath those numbers and positioning oneself to react before the currents turn into a maelstrom. This is where the concept protection before a known future date like April 2026 becomes critical. It's not about fear, it's about timing and insight. Those who wait until chaos hits are already a step behind. Those who anticipate, like Druckenmiller, gain a tactical advantage that can make all the difference. The strategy starts with awareness of the broader economic environment. Every market cycle contains subtle fluctuations in bond yields, anomalies in stock price movements, shifts in consumer behavior, and changes in central bank policies. Druckenmiller has repeatedly stressed that these signals are often dismissed by the average investor, lost in the noise of daily financial news or masked by short-term optimism. Yet he interprets these patterns as early warning systems. Protecting cash is the first actionable, translating those warnings into concrete measures. It's not merely pulling money out arbitrarily, it's aligning your liquidity with both macroeconomic realities and personal financial goals. Another layer of this approach involves understanding the psychological dimensions of market volatility. When markets turn turbulent, emotions often dictate decisions, leading to panic selling or hesitation that can magnify losses. By preemptively moving cash or adjusting positions, an investor removes much of the emotional guesswork from the equation. There's a sense of calm that comes from knowing that the assets you rely on are shielded from the brunt of sudden swings. Druckenmiller's method emphasizes that mental clarity is as valuable as financial security, and that foresight allows you to act from strength rather than fear. Practical application of this principle requires considering where cash is held and how it interacts with broader portfolio exposure. Traditional savings accounts, while convenient, are subject to inflationary erosion, and even low-risk investments like certificates of deposit can fail to keep pace with sudden cost of living spikes. Druckenmiller's strategy often involves identifying opportunities to shift liquidity into instruments or allocations that preserve purchasing power while maintaining accessibility. This could mean diversifying across short-term securities, money market funds, or even tactical cash positions that remain agile enough to capitalize on market dips without risking permanent loss. The thrill comes from crafting a dynamic plan that moves with the market rather than being trapped by it, creating the sense of control that many investors rarely experience. Timing, as always, is crucial. The emphasis on acting before April 2026 is deliberate. Markets, policy decisions, and macroeconomic pressures follow cycles, some predictable, others chaotic. Druckenmiller's experience underscores that waiting for confirmation or certainty often results in missed opportunities or exposure to unnecessary risk. The proactive withdrawal of cash is less about avoiding a specific catastrophe and more about positioning oneself strategically ahead of potential turbulence. By identifying the window in which to act, you gain both protection and leverage. You maintain the flexibility to capitalize on opportunities that arise while insulating yourself from losses that others may face blindly. Beyond the mechanics, the approach carries a deeper lesson about financial philosophy. Protecting cash before volatility is a manifestation of discipline, patience, and respect for complexity. It requires acknowledging that the financial world is not a linear progression, that comfort in numbers is often illusory, and that real power comes from being prepared for scenarios that others refuse to see. Druckenmiller's emphasis on preemptive action, a mindset that thrives on anticipation, not reaction, and it transforms the ordinary act of moving funds into a strategic statement of control and foresight. This strategy also reinforces the importance of personal responsibility in wealth management. Relying solely on institutions, advisors, or market trends without understanding the risks is a path fraught with vulnerability. By taking steps to protect cash ahead of critical dates or market inflection points, you claim agency over your financial future. The process becomes a blend of analysis, intuition, and decisive action, all guided by the principle that the best way to weather volatility is to be ready for it long before it arrives. Even as the months count down to April 26, the act of safeguarding liquidity transforms from a defensive maneuver into a proactive strategy that opens doors to opportunity. It is the difference between being buffeted by the storm and navigating it with a steady hand. Druckenmiller's insight reveals that true financial mastery is not measured by timing the highs, but by understanding the risks and positioning oneself to act with clarity, confidence, and agility when the landscape shifts. Consider now the critical step of actually withdrawing a specific amount from your bank accounts, a move that can feel both daring and necessary in equal measure. Stanley Druckenmiller has always emphasized that strategy without action is merely theory, and in this case, taking decisive steps with your cash separate passive observers from those who actively shape their financial destiny. It's not simply about moving money, it's about timing, precision, and understanding the subtle signals that indicate when an action could cost far more than taking a calculated step. Imagine sitting with the knowledge that markets are precarious, that economic pressures are building unseen beneath the surface, and that every day that passes without action could slowly erode the value of your savings. The thrill of withdrawing the right at the right time is not in reckless speculation. It's in the disciplined anticipation of risk and the art of staying one step ahead of the majority who remain paralyzed by indecision. The first layer of this strategy involves identifying exactly how much to withdraw. This is not a random figure, nor is it dictated solely by instinct or fear. Druckenmiller's approach has always combined careful analysis with a keen understanding of human behavior and market psychology. He recognizes that excessive withdrawals can be as dangerous as insufficient ones, potentially leaving you underexposed to opportunities while overcommitting resources to a defensive posture. Conversely, withdrawing too little can create a false sense of security, exposing you to the very risks you hope to avoid. Striking the right balance requires both an honest assessment of your current financial position and a clear-eyed evaluation of future market conditions, factoring in variables such as inflation, interest rates, geopolitical tensions, and economic policy shifts. Once the amount is determined, the next step involves choosing the optimal timing for the withdrawal. Druckenmiller has repeatedly illustrated that timing is as important as magnitude. Markets and economic systems do not operate in isolation. They are affected by a chain of events, some predictable, some sudden. Withdrawing funds too early may mean sacrificing potential growth opportunities, while waiting too long could expose your wealth to unexpected shocks. The edge comes from reading patterns, connecting dots that others overlook, and acting before risk becomes reality. The sense of control gained from such foresight is powerful, transforming what might feel like a routine banking task into a tactical maneuver with real consequences for your financial security. Psychological factors also play a central role in this process. Many people hesitate to remove funds from bank accounts because it challenges a sense of conventional safety. Banks are seen as sanctuaries, places where money sits securely, untouched, and under institutional protection. Druckenmiller's insight turns this conventional wisdom on its head, demonstrating that perceived safety can be illusory if external conditions shift suddenly. The act of withdrawing money, then, becomes not a reckless rebellion against, but a disciplined assertion of personal agency. It is an acknowledgement that true security is not passive. It is earned through deliberate and informed decisions. The mechanics of executing such a withdrawal require more than just visiting a teller or initiating an online transfer. It demands an awareness of liquidity, accessibility, and the instruments into which funds are temporarily placed. Druckenmiller would advocate for maintaining flexibility, ensuring that withdrawn cash is not trapped in illiquid assets or investments that could limit maneuverability in a rapidly changing environment. This stage is thrilling because it transforms theoretical strategy into tangible action, and it forces a confrontation with real numbers, real timing, and real stakes. Every decision, from the amount to the method of storage, carries implications that ripple across your financial ecosystem. Another critical dimension of this approach is the concept of optionality. By withdrawing a calculated amount of cash, you create options that others lack: the ability to pivot, invest opportunistically, or shield yourself from downside without being forced into reactive decisions. Druckenmiller's methods consistently emphasize optionality as a core principle, maintaining the ability to act decisively when market shifts occur. This is where the thrill intensifies. Unlike passive investors who are swept along by trends or surprises, those who follow this strategy are poised to leverage circumstances rather than be constrained by them. Each dollar withdrawn in a measured, strategic way is not just protection, it is a tool for future opportunity, a lever to exploit volatility rather than be victimized by it. Executing this step also reinforces a deeper understanding of personal risk tolerance. The process forces investors to confront the uncomfortable reality that even safe assets are not immune to systemic shocks. The act of withdrawal is a mirror reflecting both your capacity to manage risk and your willingness to act on insights rather than assumptions. Druckenmiller's approach turns hesitation into discipline, transforming the act of withdrawing into a conscious acknowledgement of the complex interplay between market forces, timing, and personal strategy. Finally, the thrill of this move lies in the quiet power of preparation. Withdrawing a specific amount of cash is more than a numerical adjustment. It is a psychological statement, a tangible manifestation of foresight, and a demonstration of the ability to convert analysis into action. It challenges complacency, disrupts the illusion of perpetual safety, and sets the stage for navigating the unknown with confidence and agility. Each calculated withdrawal is a rehearsal for future financial decisions, honing instincts, sharpening awareness, and building resilience in a landscape where surprises are inevitable and preparation is everything. Hedging against inflation and declining purchasing power is a principle that transforms the simple act of withdrawing cash into a sophisticated defensive strategy. Stanley Druckenmiller has always emphasized that the real enemy of wealth is not just market volatility, but the silent erosion of value that occurs when money loses purchasing power over time. When you consider the cumulative effects of inflation, even modest annual increases in prices can quietly diminish the real worth of your savings, turning what once seemed like a secure balance into a less impactful resource. Protecting against this requires more than passive awareness. It demands proactive measures, precise timing, and a mindset attuned to the shifting currents of the economy. The thrill of this strategy lies in recognizing that true financial security is not measured by nominal figures on a bank statement, but by the ability to maintain purchasing power in a world that constantly devalues it. Understanding the dynamics of inflation is the first step. Inflation is rarely a steady, predictable force. It accelerates in bursts, often triggered by policy decisions, global supply chain disruptions, or surges in demand that outpace production. Druckenmiller's approach emphasizes reading the economic signals that precede these surges. A spike in commodity prices, shifts in interest rates, or changes in fiscal policy can serve as early warnings that the value of cash may soon be under pressure. Hedging against inflation, therefore, is not reactive, it is preempted. When purchasing power is likely to decline, you position your resources to withstand the erosion, preserving the ability to act and invest when opportunities emerge. This preemptive stance transforms what could be a passive financial posture into an active and dynamic strategy. Diversification plays a crucial role in this process. Simply holding cash, even after withdrawing it from traditional accounts, may not be sufficient to outpace inflation. Druckenmiller's philosophy involves allocating liquidity across instruments that not only safeguard capital, but also maintain or increase its real value. This could include inflation-protected securities, short-term bonds, or assets that historically appreciate during inflationary periods. The key is maintaining flexibility while that a portion of your portfolio remains insulated from the eroding effects of rising prices. By doing so, each dollar withdrawn from a conventional bank account becomes a tool for preserving long-term financial stability, rather than a static number exposed to invisible decay. Timing is once again critical. Inflation does not impact all sectors uniformly or instantaneously, and policy measures can lag behind economic realities. Druckenmiller's insight lies in recognizing the lag between observable economic trends and their impact on real purchasing power. By strategically moving funds before inflation accelerates, you avoid the scenario in which reactive measures are too late to preserve value. The process requires constant observation of economic indicators, a willingness to challenge conventional assumptions, and the discipline to act decisively when signals indicate that the balance of risk is shifting. The thrill comes from the precision of action, the knowledge that you are responding to patterns that many overlook, turning insight into tangible protection. Psychological preparation also plays a significant role. Inflation often feels abstract until its effects become visible in daily life. Higher grocery bills, rising utility costs, or increased interest rates on loans. Druckenmiller's methods stress that understanding these forces intellectually is not enough. One must internalize their potential impact and act before it becomes unavoidable. Hedging against purchasing power loss requires overcoming inertia, resisting the comfort of apparent security, and taking steps that might initially feel counterintuitive. It is a mental exercise as much as a financial one, requiring discipline, awareness, and the confidence to prioritize long-term preservation over short-term convenience. The act of strategically moving funds also creates optionality. By converting cash from traditional bank holdings into more dynamic, inflation-resistant instruments, you gain flexibility to respond to multiple scenarios should markets shift, commodities surge, or policy unexpectedly tighten. Your liquidity is already positioned to withstand pressures and capitalize on opportunities. Each decision to allocate resources thoughtfully represents a lever of control in an environment that often seems unpredictable. Druckenmiller's strategy underscores that hedging against inflation is not about eliminating risk entirely. It is about structuring your financial position so that volatility works in your favor, or at least does not erode your hard-earned capital. Furthermore, this strategy reinforces the importance of continuous monitoring and adjustment. Inflation is not static, and neither should your approach be. By maintaining vigilance and periodically reassessing allocations, you ensure that your defensive measures remain aligned with evolving economic realities. Druckenmiller's emphasis on adaptability highlights the thrill inherent in this process. You are not passively waiting for conditions to change. You are actively interpreting signals, testing hypotheses, and executing adjustments with precision and foresight. At its core, hedging against inflation is a statement of financial intelligence and resilience. It transforms cash from a vulnerable static asset into a proactive tool for preserving real wealth. Druckenmiller's insights reveal that safeguarding purchasing power is not a mundane exercise in accounting. It is an act of anticipation, strategy, and disciplined execution, a way to maintain both control and flexibility in a world where economic forces constantly shift beneath the surface. Each calculated move becomes a testament to the power of foresight, the thrill of acting with purpose, and the subtle art of staying ahead when others are blindsided by the silent erosion of value. Reassessing exposure to traditional savings and low-yield accounts is a step that transforms the passive act of holding money into a proactive strategy for financial survival and growth. Stanley Druckenmiller has long emphasized that what feels safe is often the riskiest position of all. A bank account with a steady, predictable interest rate may appear comforting, but in a shifting economic landscape, its security is often an illusion. Low-yield accounts fail to keep pace with inflation, they tie up liquidity in stagnant positions, and they leave capital vulnerable to both policy shifts and market shocks. The thrill in reassessing exposure comes from the awakening realization that security is not found in numbers alone. It is created through deliberate evaluation, adjustment, and strategic foresight. Every dollar sitting idly in traditional savings is not just underperforming. It is losing the opportunity to work harder, to grow, and to provide a buffer against the unknown forces of the financial world. The first dimension of this reassessment involves a candid valuation of where your money is currently held. Low-yield accounts are often convenient, familiar, and seemingly risk-free, which makes them psychologically comforting. Yet Druckenmiller has repeatedly highlighted that comfort can breed complacency. The true cost of this complacency is subtle but relentless: diminished returns that compound over time, missed opportunities for better positioning, and a false sense of stability that can leave an investor unprepared when turbulence strikes. By systematically reviewing balances, interest rates, and accessibility, you begin to reveal where stagnation hides behind the illusion of safety. The process is meticulous, but it carries the excitement of discovery, identifying hidden vulnerabilities that most people ignore and taking steps to transform them into strategic advantages. Next comes the analysis of relative to potential reward. Low-yield accounts provide minimal growth, but they also appear devoid of immediate danger, creating a deceptive sense of invulnerability. Druckenmiller's philosophy challenges this assumption, insisting that risk must be measured not only in the likelihood of loss, but in the opportunity cost of inaction. Every dollar trapped in a low-yield account is a dollar that cannot be deployed strategically to capture upside or shield against macroeconomic disruptions. Reassessing exposure, therefore, is not merely an accounting exercise. It is a conscious act of reprioritization, a realignment of resources that transform passive holdings into dynamic tools for navigating uncertainty. This act carries its own thrill, the sense that you are no longer a bystander in your financial journey, but an active participant shaping your destiny with intention and precision. Part of this strategy involves considering alternative allocations that offer both security and opportunity. Druckenmiller has often advocated for instruments that balance accessibility with growth potential, allowing investors to remain nimble while avoiding the stagnation inherent in low-yield accounts. This could include short-term bonds, inflation-protected securities, or diversified portfolios that maintain liquidity while positioning for appreciation. The objective is not reckless speculation, but creating a structural advantage, a way to let money work while still being ready to act decisively when market conditions shift. The thrill here comes from transforming what might seem mundane, moving funds, reallocating balances, into a tactical maneuver with potentially outsized benefits. Each adjustment is a strategic pivot, a move in a larger game where awareness and timing are everything. Psychology once again plays a key role. Many investors cling to low-yield accounts because they represent certainty in a world of uncertainty. Druckenmiller challenges this mindset, showing that certainty is often illusory and that real safety comes from adaptability and informed action. Reassessing exposure requires overcoming the comfort of familiarity, confronting the subtle ways that financial inertia can erode wealth, and embracing a mindset that values flexibility and foresight over static security. The excitement of this shift lies in the empowerment it brings. By actively evaluating and adjusting positions, you gain a sense of control that few investors ever experience, turning passive holdings into a foundation for strategic advantage. This process also opens doors to tactical opportunities. By reducing overexposure to low-yield accounts, you free resources to pursue higher value allocations or to maintain liquidity for opportunistic investments. Druckenmiller's approach consistently emphasizes optionality, the ability to act decisively when circumstances change. Each dollar freed from stagnation represents a chance to move, invest, or hedge with clarity and precision. This capacity to pivot enhances both financial resilience and strategic freedom, and it transforms what could be a simple balance sheet review into a proactive exercise in maximizing potential while minimizing exposure to unseen risks. Furthermore, the act of reassessment fosters discipline. It is a systematic, repeatable process that encourages vigilance, critical thinking, and regular evaluation of financial positions. Druckenmiller's methods suggest that the key to navigating complex markets is not simply knowledge, but the ability to act on it consistently. The thrill is in the discipline itself, the awareness that by routinely questioning assumptions, recalibrating exposure, and adjusting positions, you are not reacting to chaos, you are preemptively shaping the landscape in which you operate. Ultimately, reassessing exposure to traditional savings and low-yield accounts is about converting complacency into action, comfort into strategy, and passivity into control. It transforms ordinary funds into dynamic instruments, equips you to face volatility with preparation rather than fear, and builds the mental and financial agility that separates those who survive financial turbulence from those who are overwhelmed by it. Each reassessment is a step toward mastery, a tactical decision that enhances both security and opportunity, and a vivid reminder that true financial power comes from foresight, awareness, and the courage to act before circumstances force your hand. Preparing for potential financial policy changes or economic shifts is an exercise in foresight that transforms ordinary financial planning into a high-stakes game of anticipation and strategy. Stanley Druckenmiller has long emphasized that markets and economies are shaped as much by policy decisions as by natural cycles, and those who fail to account for shifts in regulation, taxation, or central bank action often find themselves exposed when the rules change unexpectedly. The thrill of this approach in understanding that the financial landscape is never static and that the ability to adapt quickly is often more valuable than short-term gains or conventional security. Every policy adjustment, whether it's an interest rate change, a shift in fiscal strategy, or an unexpected regulatory move, carries consequences that ripple through markets, impacting asset values, liquidity, and purchasing power in ways that can be subtle or dramatic. The first step in preparing for such changes is cultivating awareness of the signals that precede them. Financial policies rarely emerge from a vacuum. They are the culmination of economic trends, political pressures, and strategic decisions made behind the scenes. Druckenmiller has long stressed that the keen investor observes these patterns, interpreting seemingly minor policy hints as early warnings of larger shifts. The thrill of this observation is in decoding complexity, in reading between the lines of central bank statements, government fiscal reports, and market behavior to anticipate moves before they become headline news. This proactive mindset transforms ordinary market participation into a strategic exercise, where awareness and intuition combine to create advantage over those who react only after events have unfolded. Understanding the potential impact of economic shifts is equally important. Not all changes are created equal, and the way a policy affects your financial position depends on timing, exposure, and allocation. Interest rate hikes, for instance, can increase borrowing costs, decrease bond values, and influence stock market dynamics, while fiscal changes such as tax assessments or stimulus measures can shift disposable income, consumer behavior, and investment sentiment. Druckenmiller's approach emphasizes mapping these potential outcomes and positioning resources in a way that minimizes vulnerability while maintaining the ability to capitalize on new opportunities. The thrill comes from the strategic foresight this requires, imagining multiple scenarios simultaneously and identifying moves that protect wealth while keeping options open. Liquidity management becomes a central component of this strategy. When policy shifts occur, markets can react rapidly and unpredictably, creating periods of volatility where access to liquid resources becomes critical. By preemptively structuring portfolios with a mix of cash, short-term securities, and flexible investments, an investor ensures the ability to respond decisively rather than being forced into reactive decisions under pressure. Druckenmiller's insight highlights that preparation is not simply defensive, it is tactical. Maintaining liquidity allows you to act on opportunities, whether it's acquiring undervalued assets during market dips or reallocating funds to safer havens. Turning potential disruption into a strategic advantage, psychological readiness also plays a crucial role. Financial policy changes can provoke panic, indecision, or overreaction in investors unprepared for uncertainty. Druckenmiller's philosophy emphasizes the importance of mindset cultivating calm, disciplined awareness in the face of potential turbulence. Preparing for policy shifts is as much about mental agility as it is about financial maneuvering. The ability to remain objective, analyze emerging information quickly, and act decisively differentiates those who can preserve and grow wealth from those who are swept along by uncertainty. The thrill here is subtle but powerful. It's the knowledge that by anticipating changes, you control the pace and nature of your response rather than being controlled by external forces. Scenario planning is another critical aspect of this approach. Druckenmiller consistently advocates for envisioning multiple potential futures, assigning probabilities, and preparing contingent strategies for each. This could involve reallocating assets, adjusting exposure to interest-sensitive investments, or temporarily increasing liquidity in anticipation of policy-driven market shifts. The excitement lies in the strategic puzzle, identifying actions that perform well across multiple scenarios and minimize downside while preserving upside potential. Each adjustment is a calculated move in a complex, dynamic system, turning uncertainty into a domain where preparation equals advantage. The interplay between macroeconomic trends and individual financial positioning creates a continuous feedback loop. Policies respond to economic conditions, and these changes in turn impact individual portfolios, creating a landscape in which every decision carries amplified significance. Druckenmiller's approach emphasizes reading this feedback intelligently, interpreting signals, and adjusting proactively rather than waiting for events to force reactive measures. The thrill comes from operating within this dynamic, understanding that every informed adjustment is a step ahead of the market, a tactical maneuver that transforms potential disruption into opportunity. Preparing for policy and economic shifts also reinforces the importance of adaptability over rigidity. Static strategies that ignore external changes are vulnerable, no matter how well constructed in theory. Druckenmiller demonstrates that true financial resilience is not about predicting the future with certainty, but about designing positions and strategies capable of absorbing shocks while remaining positioned for advantage. The act of preparing is itself empowering. Each decision to adjust exposure, maintain liquidity, or anticipate regulatory changes strengthens your capacity to act decisively and confidently when the environment changes. Ultimately, preparing for financial policy changes and economic shifts is a practice in anticipation, discipline, and strategic foresight. It converts awareness into action, risk into opportunity, and complexity into a domain where decisive preparation can yield tangible advantage. The process is thrilling not because it guarantees certainty, but because it transforms potential chaos into a calculated landscape where insight, timing, and flexibility converge to create a clear edge over those who remain passive, reactive, or unaware. Following Druckenmiller's strategy of proactive risk management is the culmination of all previous steps, transforming awareness, anticipation, and action into a disciplined framework that can navigate uncertainty with precision. Risk management, in his philosophy, is not merely about avoiding loss, it is about controlling exposure, preserving optionality, and positioning oneself to act decisively when volatility arises. The thrill in this approach lies in its dual nature. It is both defensive and opportunistic, a strategy that protects capital while simultaneously creating pathways to capitalize on market dislocations. Druckenmiller has repeatedly illustrated that those who wait for certainty or rely solely on conventional safeguards often find themselves vulnerable, while those who embrace calculated risk with foresight command both flexibility and power. The first principle in proactive risk management is identifying vulnerabilities before they become crises. This requires a granular understanding of your entire financial ecosystem: cash holdings, investment allocations, exposure to interest rate fluctuations, inflation policy shifts, and market sentiment. Druckenmiller has emphasized that risk is multidimensional, encompassing not only the potential for loss but also erosion of purchasing power, missed opportunity, and overexposure to systemic threats. Proactive management involves a continuous process of monitoring these dimensions, anticipating how changes in one area may ripple through others, and acting in advance to recalibrate positions. This anticipatory stance creates an intellectual and emotional edge, transforming uncertainty from a source of fear into a landscape where informed decisions drive advantage. Another key component is diversification with intentionality. Druckenmiller's strategy highlights that true risk management is not about spreading resources blindly across asset classes, but about constructing positions that balance risk, liquidity, and growth potential. Diversification is a dynamic process, constantly reassessed in light of evolving economic indicators, geopolitical developments, and market sentiment. The excitement comes from the constant evaluation and adjustment, deciding which exposures to maintain, which to reduce, and which opportunities to seize. By managing risk proactively, each allocation becomes a tactical maneuver, a calculated step that preserves capital while keeping the potential for gains alive. This approach creates a portfolio that is not just safe, but strategically positioned to exploit positions when others falter. Timing is central to proactive risk management. Druckenmiller has repeatedly shown that the difference between preservation and loss often comes down to acting before stress points manifest visibly in markets. Waiting until volatility hits or crises are reported in the news usually results in reactionary decisions, emotional trading, and forced compromises. Proactive risk management flips this paradigm. By anticipating potential disruptions, you gain the power to act on your own terms. The thrill of timing is in the precision it demands, the awareness of economic signals, policy shifts, and market patterns that indicate when exposure should be reduced, liquidity increased, or positions adjusted. It's a constant game of pattern recognition and decisive action that separates passive investors from those who move strategically through uncertainty. Psychology plays a pivotal role in this framework. Market swings and financial turbulence often trigger fear, hesitation, or overconfidence, leading to decisions that compound risk. Druckenmiller's approach underscores the importance of cultivating discipline, mental clarity, and emotional resilience. Proactive risk management is as much about mastering one's mindset as it is about manipulating numbers and positions. The thrill lies in the intellectual rigor of maintaining composure, interpreting signals accurately, and making informed decisions that others might overlook or avoid due to emotional bias. Each action taken within this framework reinforces a sense of control, converting potential anxiety into opportunity. Scenario planning and stress testing are also essential. Druckenmiller advocates envisioning multiple outcomes, analyzing potential shocks, and structuring resources to absorb impact while retaining agility. This could involve maintaining liquidity, hedging specific exposures, or strategically reducing positions in areas most vulnerable to macroeconomic or policy-driven disruption. The excitement comes from this mental modeling, the ability to simulate complex market environments, anticipate cascading effects, and position oneself to benefit from the movement of the broader system rather than being buffeted by it. Each adjustment becomes a tactical advantage, a maneuver that converts insight into actionable security and opportunity. The concept of optionality is deeply intertwined with proactive risk management. Druckenmiller emphasizes that preserving the ability to act decisively is as important as protecting against loss. By actively managing exposure, diversifying intelligently, and anticipating market shifts, investors maintain options that others lack: the freedom to allocate resources to emerging opportunities, to hedge selectively, or to capitalize on volatility in ways that reactive strategies cannot achieve. Each preemptive adjustment enhances flexibility and empowers decision-making, creating a strategic environment where risk is controlled, but opportunity remains alive and accessible. Finally, proactive risk management reinforces the philosophy that control, foresight, and adaptability are superior to passivity. Druckenmiller's methods demonstrate that wealth is not merely accumulated through luck or static investment strategies, but through disciplined observation, anticipation, and calculated action. Every measure taken to monitor vulnerabilities, adjust positions, and maintain flexibility strengthens the capacity to thrive amid uncertainty. The thrill in following this approach is both intellectual and practical. The knowledge that you are not at the mercy of external forces, but actively shaping your financial landscape, managing exposure with precision, and positioning yourself to capside while minimizing downside.